Hi, I'm Valerie Squire, the broker owner of Homestar Real Estate. I'm joined here today with Stephanie Whiting from Mason McDuffie Mortgage. We wanted to do something a little bit fun and casual today, go over some myths of real estate and the mortgage industry. So, are you ready for this?
I am.
Okay, let's get it started. Always choose the lender with the lowest rate.
Ooh, that's a good one.
Yeah.
So I have conversations with people a lot about interest rates. What are the rates? And rates vary by so many different factors. You're talking by company, you're talking by property type, you're talking by credit score, and you're talking about how much money you're putting down as the down payment. Interest rates are based on risk. So while most of the time companies will have similar rates, and oftentimes they may even post copies of their interest rates online, but the downside to that can be, if they have the lowest possible rate, what could happen is, if they can't close that loan in a timely manner, and let's say you're no longer able to purchase that home because you can't close on time, a low rate won't matter if you don't have a home to pay that mortgage on. And oftentimes they'll offset the low rate with higher, what we call as junk fees. And so that could be another thing that you may see a difference in between a low rate and higher fees versus average rates and average fees, or very high fees and low rates.
Okay. So it's kind of also, I would think you would want to be comfortable with your lender. You would want your questions answered.
Huge.
Yeah.
So, education, you're going to be going into debt for 30 years. I think that's kind of
biggest purchase of somebody's life.
Right. An important thing for you to be educated about going into something like this. And, if your loan officer is not answering the phone, or if they're not available and in very good communication with your real estate agent, realtor that you're using, that could kind of almost be a precursor to what could be happening if you end up buying a house or getting into contract on a house.
Right. Red flags.
Yeah. and again, largest transaction or purchase of your entire life. Like it's a big deal, and it should not be taken lightly.
I agree.
So I have a myth for you for a real estate agent.
Okay.
Buyers should always start with the lowest offer or a low offer.
Okay. So, I get this a lot. Buyers will come in and say, well, it's listed at X amount. I want to go in this much lower. I want to start it off. We can start from there. And, as I encourage people to go ahead, and everything's a negotiation, we do want to make sure we're not going to insult a seller right off the bat and come in very low. It could just kind of break down the negotiation and the communication right from the start. So what I always do when we find a house that the buyer loves, we go ahead and we pull comps from the neighborhood and from the area, see what's on the market, what's pending, and what has sold in the past 6 to 8 months. So that way we have a real good market picture of what is going on there. We want the house to appraise. We don't want to just throw an offer out there and then be stuck with a appraisal issue or a value issue down the road.
Yep.
Yeah.
Awesome.
Yeah. So number 2 myth for you: pulling credit for a pre-approval will mess up your credit score.
Ooh. So I think that's one of the hugest issues that I come across right now is people are very hesitant to run their credit. They're even just hesitant to even talk really on the phone, to even come into an office, to have a conversation with people about buying and what it takes.
Right.
Well, I want to know what I can afford, but don't run my credit yet.
Don't touch my credit.
We could get an idea. Like, we are talking so very rough estimate that it's going to be a huge range that it wouldn't even make sense for you to
what
even
you
consider.
mentioned with your rates. It's
Right.
all dependent
it's all
on so many
risk
things.
based. So we have to know what your credit looks like in order for us to determine what rate that we could potentially offer you. And then in addition to that, this is kind of like an algebra problem. We have to work backwards. We have to know what your income is, what mortgage payment potentially could be, and then work backwards to what you could potentially afford from how much house that would become. So to say that, I don't want my credit to be ran because it will hurt my credit. One inquiry won't hurt your credit. Mm-hmm. And what we don't want is for you to go out and, run your credit 5 times this month and, get a Kohl's card because you saved 20% on a pair of jeans. Right. One inquiry, be it a mortgage inquiry in general, is not going to tank your score. And we run your credit once. It's
Right.
valid for 4 months.
Wow.
It's not
Okay.
going to change. That's what we will end up going off of. Now, if it takes you 4 months to find a home and you find one and your credit scores have expired since then, because a lot can happen in 4 months.
Right.
We'll end up having to rerun your credit to get a new valid credit report so that it's, again, valid for another 4 months.
Okay. So just don't go around getting credit cards, going and
don't-
shopping the rate everywhere.
I mean, you usually have a window of about 2 weeks to really do some serious home shopping. And when I say serious home shopping, you're talking about just mortgage shopping in general. You know, whether that's you see one person or 2 people or 3 people to really get a pre-approval, those 3 inquiries within that 2-week period are not going to make that much of a difference on your score.
Okay, that's really good to know.
So I have another question. Cash offers always win.
Always, yeah. No, that's not true. So, it is a lot of times people think their cash offers are going to beat anyone out. What I see happening sometimes is people come in with a cash offer. They can close quickly, but they come in less than list price. So if a buyer who's getting a 30-day, a loan that is going to be a 30-day close of escrow comes in, they, really love the home. They're going to live in the home and they want to make it their future and everything. They come in and they put an offer in, and me as your agent has good communication with the other agent. You as the mortgage officer would basically, we have a lot of communication with that other side. So just because an offer comes in as cash, there's things that we do when we represent you to make sure that your offer is a full package and basically presented in the best light. So that is a myth. Okay.
Interesting.
And another one for you. To buy a home, you need to have 20% down.
That is the story of my life.
Right.
So obviously false, and I can tell you many reasons why it would be false, a handful of reasons. One would be, the Federal Housing Authority, FHA, does allow people who haven't owned a home within the last 3 years to put down 3.5% as a down payment. So that's already completely busted right out of the gates.
Right.
On a conventional loan, you can even as a first-time buyer put down 3% as well. So there's a lot of options out there. And so some people even say, well, I don't even have 3%. I don't even have 1%.
Right.
How am I able, or maybe I can't even buy a house because I don't even have 3%. And so I think a lot of people get discouraged thinking still, even to this day in 2020, that you do need to have 20% down to buy a home. I'm a living testimony that you don't need to have 20%. In addition to that, you don't even necessarily need to have 3% or 3.5%. I was able to take advantage of down payment assistance programs that helped subsidize the difference between what we had available in money to use to buy, and then the difference between that and what the down payment was and what the closing costs were. So we were able to, use money that we had available, which wasn't much. We only had about $9,000, and we were able to get into a home with only $9,000 out of our own pocket. That's not a typical scenario. I mean, I've had clients who come in and buy a house with no money out of pocket. Mm-hmm. So, I mean, there are a lot of things that can be done to get you into a home as a first-time buyer, or even a third or fourth-time buyer. You're considered a new home buyer, every 3 years if you don't own a home.
Okay, so wait, that's myth number 4, and I want to ask you because we're going into that.
All right.
First-time home buyer programs and down payment assistance programs are only for people who have never bought a home before.
And I was already touching on that.
You were going into that.
I was already going into that. So you don't have to be a first-time home buyer to utilize down payment assistance, and you don't need to be a first-time home buyer to utilize a down payment of 3.5% on an FHA loan. If you owned a home, let's say, and you lost it in the last recession, a lot of people had problems, and a lot of people lost homes back then. If you haven't owned a home longer than 3 years, primary residence, then you're considered a first-time buyer again. Oh. Now, let's say you have a rental, and you're saying, well, I've been renting where I currently live. I have a rental somewhere else. I'm not a first-time buyer. Mm-hmm. Well, technically you are a first-time buyer because you're buying a primary residence. You're not buying another rental property. Right. You're buying a primary residence. And so there are down payment assistance programs even then that will help offset your down payment if you still don't have that 3.5% with FHA, and you're not required to be a first-time home buyer either.
Wow.
A lot of myths out there.
There are.
Right.
Yeah.
So I have one for you.
Okay.
Buyers need to pay their real estate agent or are responsible for paying their real
Right.
estate
Okay.
agent.
So I get a lot of times buyers they're a little nervous. Well, how do you get paid? Where does that come from? And I want everyone to know that is part of the sellers. What they negotiate with their listing agent, it comes out of the seller's proceeds, all the commissions for both real estate agents. So buyers, don't worry, you're covered there. So.
Yeah, and we're going to make sure that, you, even as a lender, we're commission based. We don't get paid until you close on a house. So while yes, our paycheck depends on it, that's not our goal. Our goal is to help you become a homeowner because ultimately we know it's just going to make your lives even better.
Right.
So.
Okay. Let's see, another myth. 30-year fixed rates are the best deal.
Ooh, that's a good one. So rates are kind of going crazy right now. The markets are kind of shifting. And so a lot of people are having that conversation. What are the rates right now? What is it worth it for me to buy? Rates are obviously heavily impacted when it comes to, buying a house in general. But, rates are, they fluctuate. They change every day. So a lot of things can play into what's the best type of program for you. If you're looking to get in with a very short investment, there are different types of programs out there that may be more beneficial to you, whether that's a 10-year fixed adjustable rate mortgage where that payment is fixed for 10 years because you're saying, look, I know for sure I'm going to be out of this house in 6 years or 7 years, and I'll sell it in that time. Then you don't have to necessarily worry about that 11th year coming up and it adjusting.
Right.
So it's really based on your situation, your individual goal, whether that's 5 years, 10 years from now, and what you're looking for. If stability is your thing, then a 30-year fixed rate mortgage is oftentimes the easiest and more predictable way to pay your mortgage without any questions. These adjustable rate mortgages, if people aren't prepared for it to adjust, it can come to them as a shock when they get a higher mortgage payment after that.
And we were
fixed
seeing
period.
that a lot in the
past
crash.
Years,
yeah.
So. Well, during the crash, there was a lot of adjustable rate mortgages.
Mm-hmm.
There were a lot of predatory type loans that were out there. And those are, I'm not going to say that adjustable rate mortgages are predatory in nature. Right. They're very heavily regulated.
Absolutely.
But it's all depending upon what you as the buyer are comfortable with and what we see and look at as your financial picture as a whole. A lot of that is all determined based on that information.
So that's why it's so important to actually sit down and talk with your mortgage people and not just go online and try to get a pre-approval or something because those are just kind of blanket pre-approvals.
Yeah, they're almost as worth the paper they're printed on.
Oh wow, not quite though. Huh?
Not quite. And I say that because you can fill out information online with a company that is mainly online, and they'll use software systems that will allow you to generate some sort of pre-approval letter. But once you get in front of that underwriter, a whole different set of rules could apply when they start really digging into, the nitty gritty of whether that's your income or your credit. There's so many factors that go into it.
Right.
You're going to want to know, what you're getting yourself into. Again, you're going into debt for 30 years, trying to go online to get a mortgage and not knowing really truly what that information means to you and how that affects you, not just now, but 5 years, 10, and even 20 years down the road, I think is imperative.
Right.
You need to know this information. It's not like going to the car dealership and spending 8 hours. You should be spending almost that same amount of time, if not more, trying to figure out, is it worth it for me to buy a house? Is it worth it for me to refinance? And if you're not being educated in that, run for the hills and find someone who will.
Right.
So, okay, so I have another one for you.
Okay.
Spring is the best time to sell.
Oh, wow. This is, again, you can't fit one person into one category. So spring is not always the best time to sell. Buyers come out a lot in the springtime, but, people sell their homes in the end of the school year. People sell their homes in wintertime. A lot of times there's less inventory on the market, so wintertime can be really good when it comes on the market. There's less competition, less houses for those buyers to see. So I say it's the right time to sell when it makes sense for you and your family. If you need to know what your home is worth, we're always happy to take a look and give you a market analysis of what it's worth to see if it makes sense for you timing wise and equity wise. So I would say that's a myth.
Yeah. I would agree with that.
Yeah. Okay. Refinancing isn't a good idea.
So a lot of people will buy their homes and then are like, I want to pay this off really fast. I don't want to, I want to put more money towards my principal. I want to lower my balance. There are a lot of things that can go into, again, you're going into debt for 30 years. So let's talk about what your plan is over, not that you're going to have a solid plan and life changes, things happen, but what does that look like over, now and 5 years from now and 10 years from now? So if let's say you get into a house and you used down payment assistance, or you put, used your own money and you put down 3.5%, oftentimes you're going to have what they call mortgage insurance. And so mortgage insurance is, unfortunately, I believe right now, may or may not, check with your tax professional. Mortgage insurance, at least the last I heard, is no longer a deduction for you to write off as on your tax return as a housing expense. At one point it was, and then it got pulled away. I don't know if it's been pushed back, but you want to be able to reduce your payment. I mean, who doesn't want to save money?
Right.
I think that's really the question. You can save money by refinancing and essentially redoing your loan over again over that 30-year period. Ultimately, yes, extending that 30-year period over again. But if, let's say, you're saving $300 a month in mortgage insurance and you've been in the house for 3 years, another 3 years added on to that 30-year time, to that, redoing a 30-year mortgage when you've been paying it for the last 3 years and you're now down to 27. I mean, you're going to be saving $300 a month.
I'll take the $300 a month.
Right.
Yeah,
I mean, so it kind of just really depends. And in reality, who's paid off their mortgage?
Yeah. There's some
Because
people. Good for you.
There are some people who do pay their mortgage off. I think, when we look at what does this home mean to you and what do you have planned in the future 5 to 10 years from now, there's a solid chance that you're not going to be in that home anymore. You're going to be interested in selling that home because now you have enough equity in it so that you can turn around and use that equity that you've earned to put down as a down payment on another house. Whether that's upsizing and getting a bigger house because now you have more family members, or downsizing because, the kids have flew the nest and now you don't need this much space and you don't want to clean a 5-bedroom house. You only want to clean a 2-bedroom condo. I mean, there are so many reasons why refinancing would be good, would be to obviously save money, albeit mortgage insurance, or even potentially just rates in general. I mean, you can save, hundreds of dollars just refinancing your loan and lowering the amount of interest that you pay over that 30-year period. So
Great.
Thanks for watching. Subscribe for future real estate videos. Bye. Homestar Real Estate.